Hello, friends. Welcome to today's video, where we're going to explore why most traders fail, according to Mark Douglas. This powerful topic is taken from his book, The Disciplined Trader, where he explains the biggest psychological mistakes that cause traders to lose money, from emotional decision-making to the failure of accepting risk. If you've ever wondered why some traders succeed while others keep struggling, this video will give you deep insights into the mindset that separates winners from losers. So, make sure to watch till the end and don't forget to like, share, and subscribe for more trading psychology insights. Now, let's get started. Lack of psychological preparedness. Most traders enter the market believing that success is all about strategy, finding the perfect indicator, the best setup, or the most reliable chart pattern. But Mark Douglas makes one thing very clear. The real challenge is not in the strategy, it's in your mind. Let's break it down. When you place a trade, the market doesn't care who you are, what you think, or how badly you want to win. It doesn't operate on your emotions. It's completely neutral. But here's the problem. Traders are not neutral. They attach emotions to every price movement. When the market moves in their favor, they feel excited. When it moves against them, they feel fear, anxiety, or frustration. The market doesn't generate happy or painful information. It's neutral. It's the trader's perception and response that creates emotions. Mark Douglas. This is where most traders fail. They don't prepare themselves psychologically. They don't realize that their own emotions, fear, greed, hope, and regret, are shaping their decisions more than their strategy ever could. Fear and greed, the silent killers. Fear and greed are the two strongest forces that dictate market behavior. When traders see a trade going against them, fear takes over. Instead of following their plan, they panic and exit too early. On the other hand, when a trade is in profit, greed kicks in. They hold on for too long, hoping for more, only to watch their gains disappear when the market reverses. A disciplined trader doesn't let emotions dictate their actions. They understand that the market moves in probabilities, not certainties. Instead of reacting emotionally, they stick to their plan, accepting both wins and losses as part of the game. Hope and regret, the cycle of destruction. How many times have you entered a trade, watched it go against you, and instead of cutting your losses, you hoped it would turn around? This is one of the biggest psychological traps in trading. Hope keeps traders in bad trades far longer than they should be. By the time they realize their mistake, the loss has grown too big to handle. Then comes regret. The regret of not following the plan, the regret of not taking profits earlier, or the regret of missing out on a move. This regret leads to emotional decision-making, causing even more mistakes. It's a vicious cycle. The solution: building psychological strength. If you want to succeed in trading, you have to train your mind as much as you train your technical skills. Mark Douglas emphasizes that successful traders are not emotionally attached to their trades. They understand that losses are part of the process, and they focus on executing their edge rather than reacting to every tick in the market. So the question is, how do you train yourself to think like a disciplined trader? The answer lies in self-awareness. You need to recognize when emotions are driving your decisions and consciously step back. Keep a trading journal. Analyze your emotional responses and build the habit of detaching yourself from the outcome of any single trade. Because at the end of the day, the market isn't your enemy. Your lack of psychological preparedness is. Failure to accept risk. One of the biggest reasons traders fail is their inability to accept risk. They enter the market hoping to win, but they don't fully embrace the reality that losses are an inevitable part of trading. And when they do face a loss, they panic, hesitate, or make irrational decisions. You don't need to know what's going to happen next to make money. You just need to execute your trades without fear. Mark Douglas. This is where most traders go wrong. They believe they need certainty to succeed. They want a system that tells them exactly when to enter and exit with zero risk of failure. But here's the truth. Certainty doesn't exist in the market. Fear of losing, the silent killer. Imagine a trader who has just suffered a few back-to-back losses. The next time they see a setup, they hesitate. What if this trade also fails? What if they lose more money? This fear grips them so tightly that they either don't take the trade at all or they enter but exit too early before the trade even has a chance to work out. On the flip side, some traders do the exact opposite. They refuse to accept that losses are normal, so they start increasing their position size, hoping to recover quickly. This reckless behavior often leads to even bigger losses. In both cases, the problem is the same. They are not comfortable with risk. Embracing uncertainty, the mark of a professional trader. A professional trader understands that trading is a probability game. Not every trade will win, but over a series of trades, a well-executed strategy will be profitable. Instead of focusing on the outcome of a single trade, they focus on the process, executing their edge consistently, regardless of short-term results. This is what Mark Douglas emphasizes. The key to success is trading without fear. Fear only exists when you believe the market should behave a certain way, but when you accept uncertainty, the fear disappears. Risk management, the secret weapon. If you truly accept risk, then you plan for it. That means position sizing. Never risk more than you're comfortable losing. Stop losses. Every trade should have a predefined exit point. Emotional control. Whether you win or lose, your next trade should be executed with the same discipline. Risk management isn't just about protecting capital. It's about protecting your mindset. When you know that one trade doesn't define your success, you can trade with confidence. The bottom line, if you can't accept risk, you can't trade, period. The moment you shift your mindset from trying to avoid losses to executing your strategy without fear, everything changes. Because in trading, it's not about being right all the time. It's about managing risk, embracing uncertainty, and staying in the game long enough for your edge to play out. Emotional trading and impulsiveness. One of the biggest mistakes traders make is letting their emotions control their decisions. They start with a plan, but the moment things don't go their way, emotions take over and they react impulsively. This is what separates professional traders from amateurs. The best traders are not afraid. They don't hesitate. They act when they need to act. Mark Douglas. The market doesn't reward emotions. It rewards discipline. Let's break down the two biggest emotional traps that lead to failure: revenge trading and overconfidence. Revenge trading, the trap of desperation. Imagine this. You just took a trade and it went horribly wrong. You feel frustrated. Instead of accepting the loss and sticking to your plan, you immediately jump into another trade without proper analysis, just to make it back. This is revenge trading, and it's one of the fastest ways to blow up an account. When traders let their frustration drive their decisions, they start making random, impulsive trades. Instead of executing a strategy, they are reacting emotionally, trying to fight the market. Here's the hard truth. The market doesn't care about your losses. It won't give you your money back just because you're upset. Every trade should be taken with logic, not emotions. Overconfidence, the illusion of invincibility. Now, let's look at the opposite problem. You just had a series of winning trades, and suddenly you feel unstoppable. You increase your position size. You start taking trades outside of your strategy. You ignore risk management because in your mind, you've got this. Then, reality hits. The market doesn't care about your winning streak. One wrong move and all your profits disappear. This is why Mark Douglas emphasizes that professional traders don't get attached to wins or losses. They follow their process, trade after trade, without hesitation and without arrogance. Fear and greed, the invisible forces. Fear makes you hesitate, cut winners too soon, or avoid taking trades. Greed makes you overtrade, chase bad setups, and take excessive risks. If you let these emotions take over, even the best trading strategy will fail. The solution: building emotional discipline. 1. Create and follow a trading plan. If you don't have rules in place, emotions will control your decisions. 2. Accept every trade as just one of many. Stop treating individual trades as life or death situations. 3. Use proper risk management. If your risk is under control, you won't feel the need to react emotionally. 4. Take breaks after big wins or losses. If you feel emotionally charged, step away from the screen before making another trade. The bottom line: trading is a game of discipline. If you let emotions control your actions, you're not trading, you're gambling. The best traders don't hesitate. They don't second guess, and they don't seek revenge on the market. They act when they need to act. No emotion, no impulsiveness, just execution. Over-reliance on technical analysis without understanding market psychology. Many traders believe that the key to success lies in finding the perfect indicator or chart pattern. They think if they just master technical analysis, they'll be able to predict market moves with certainty. But Mark Douglas makes it clear, charts don't predict the future. Charts don't predict the future. They help you see what's happening now so you can act accordingly. This is where most traders go wrong. They treat technical analysis as a crystal ball rather than a tool for understanding market behavior. Let's break down why this approach leads to failure. The illusion of certainty. New traders often fall into the trap of believing that if they just find the right setup, they can guarantee a profitable trade. They obsess over moving averages, RSI, Fibonacci retracements, and candlestick patterns, thinking these tools will tell them exactly what the market will do next. But the market isn't a machine that follows fixed rules. It's a living, breathing system driven by human emotions, supply and demand, and ever-changing conditions. A perfect setup doesn't mean the trade will work out. There is no certainty, only probabilities. Ignoring market sentiment. A trader who focuses only on technical patterns but ignores the psychology behind price movements is trading blind. Here's why. Support and resistance levels don't hold because of lines on a chart. They hold because traders collectively believe in them. Breakouts don't fail just because of a fake-out pattern. They fail because market sentiment shifts. Indicators don't work because they are mathematically perfect. They work because traders react to them in predictable ways. Successful traders don't just follow indicators. They understand why those indicators work. They look beyond the chart to analyze the emotions and behavior driving price action. The missing piece, understanding market psychology. Imagine two traders looking at the same breakout setup. One sees a clean technical pattern and enters immediately. The other asks, is this breakout happening on strong volume? Are traders positioned heavily in one direction, making a reversal likely? Is there news or an event that could impact sentiment? The first trader blindly follows the pattern. The second trader understands the context and makes a decision based on both technicals and psychology. Who do you think has the edge? A trading strategy is just a tool. Execution is the skill. Mark Douglas emphasizes that technical analysis alone won't make you profitable. It's a tool, but your ability to execute it correctly is what matters. Do you take trades mechanically, or do you understand why they work? Do you blindly trust indicators, or do you adapt to market conditions? Do you expect the market to behave a certain way, or do you react to what it's actually doing? The best traders don't predict, they react. They use technical analysis as a guide, but combine it with an understanding of how traders think, feel, and behave under different market conditions. Lack of a trading plan. One of the biggest reasons traders fail is because they don't have a solid trading plan. They enter the market with excitement, but no real strategy. They rely on gut feelings, random setups, or emotions. And that's just gambling. Without a plan, a trader is gambling. Mark Douglas. A professional trader never takes a trade without a plan. Every move is calculated, every risk is managed, and every decision is based on a well-defined strategy. Let's break down why a lack of planning leads to failure. Trading without a plan, emotional chaos. Imagine a trader who enters a trade just because a stock looks strong. They don't have a clear entry price, no stop loss, and no idea where to take profits. What happens next? If the trade goes against them, they panic. Should they exit or hold? Fear clouds their judgment. If the trade goes in their favor, greed takes over. Should they take profits or wait for more? Overconfidence leads to bad decisions. Without a plan, every trade turns into an emotional roller coaster. The trader isn't following a strategy, they're reacting to emotions. And in the long run, that's a guaranteed path to failure. The elements of a strong trading plan. A real trading plan isn't just about when to enter. It includes 1. Entry rules. What conditions must be met before you enter a trade? Is it based on price action, indicators, or news? 2. Exit strategy. When will you take profits? Will you exit at a fixed target or trail your stop loss? Stop loss. Stop loss. What is the maximum risk you're willing to take on each trade? 4. Position sizing. How much of your capital will you risk per trade? 5. Market conditions. Does your strategy work in all market environments or only in trending or ranging conditions? Without these rules, trading becomes random gambling instead of a structured process. Hash the power of consistency. Mark Douglas emphasizes that the best traders are consistent. They don't win because they have a secret indicator or insider knowledge. They win because they execute their plan the same way, every single time. They don't chase trades. They wait for their setup. They don't hesitate or second guess. They follow their rules. They don't risk everything on one trade. They manage their capital wisely. This consistency is what separates professionals from amateurs. Why most traders avoid making a plan? If a trading plan is so important, why do most traders ignore it? Simple. It requires discipline. A plan forces you to take responsibility. You can't blame the market, the news, or bad luck. If you lose, it means you either didn't follow your plan or your strategy needs adjustment. Many traders don't want that level of accountability. They prefer the illusion of control, making decisions based on feelings rather than logic, not learning from mistakes. One of the most common reasons traders fail is their inability to learn from their mistakes. Every trader makes mistakes. It's inevitable. Even the best traders in the world take losses. But what separates successful traders from those who fail is how they handle those mistakes. Trading mistakes are inevitable, but failing to learn from them is a choice. Mark Douglas. Most traders repeat the same errors over and over again, hoping for a different result. They don't analyze their past trades, they don't adjust their strategy, and they don't take responsibility for their actions. This keeps them stuck in a never-ending cycle of failure. The dangerous cycle of repeating mistakes. Here's how a typical losing trader's cycle looks. 1. They take an impulsive trade. Maybe they enter too early, ignore their stop loss, or let emotions control their decision. 2. They lose money. The market goes against them, and instead of accepting it as a learning experience, they feel frustrated. 3. They blame external factors. Instead of analyzing what went wrong, they blame the market, news, or bad luck. 4. They make the same mistake again. Since they never reviewed their mistake, they repeat it in the next trade. And this cycle keeps repeating until their entire trading account is wiped out. The solution. Keeping a trading journal. Mark Douglas and other professional traders emphasize the importance of keeping a trading journal. Why? Because it helps you spot patterns in your behavior and improve over time. A trading journal should include the reason for entering the trade. Was it based on your strategy or was it an emotional decision? Your emotions during the trade. Did fear or greed influence your choices? What went right or wrong? Did you follow your plan or did you deviate from it? What you learned. What would you do differently next time? By consistently reviewing your past trades, you'll start noticing patterns in your mistakes. And once you identify those patterns, you can fix them and improve. Taking responsibility, the key to growth. Most traders struggle to accept responsibility for their mistakes. They prefer to blame external factors. The market was manipulated, the news was unexpected, or the broker was against them. But the truth is, the market doesn't care about your feelings. Successful traders take full responsibility for their decisions. They don't make excuses. They analyze, adjust, and move forward. If a trade went wrong, they ask, what could I have done better? If they hesitated to enter, they ask, why did I doubt myself? If they ignored their stop loss, they ask, what emotions caused me to do that? This mindset shift is what separates winners from losers. If you don't own your mistakes, you can't fix them. And that's the harsh reality of why most traders fail. If you let emotions take control, make impulsive decisions, or refuse to accept risk, failure is almost guaranteed. But here's the good news. You can break the cycle. Develop discipline, learn from your mistakes, and treat trading like a skill that needs constant improvement. Because at the end of the day, the market doesn't reward the smartest traders. It rewards the most disciplined ones. If you found this video valuable, make sure to like, share, and subscribe for more trading psychology insights. And let me know in the comments, what's the biggest trading mistake you've learned from? See you in the next one.